Oh, happy day. Oh, happy day. Today, Elon Musk announced that he is putting in an offer to buy 100% of Twitter and take it private. Oh, yeah. For about $43 billion, Elon is going to buy Twitter. I'm so excited about this, but I bet you're wondering, is this actually going to happen? When will this happen? What else could happen here? And most importantly, should you buy? Should you jump on the Twitter bandwagon right now because free speech is coming and Elon Musk is about to be the owner of Twitter? Or should you bide your time and look elsewhere for quick profits? Well, in today's episode, I'm not only going to tell you whether or not I'm buying, but I'll also show you exactly how I came to my confident conclusion. Maybe you can learn from me, but obviously, this is not financial advice. I'll help you think for yourself about whether you should buy Twitter, or maybe, hold off for a little bit and figure out how you can maximize your probability of coming out on top. Even though Elon says he doesn't care about making money off this Twitter acquisition, it's still important to consider because maybe we can all ride this boat up together and celebrate in the glorious bath of free speech that Elon Musk is about to rain upon us. All right, if you're interested in learning more about what Elon Musk is going to do with Twitter and how this could benefit you, stay tuned and let's begin. Hey everyone, Rosario here and welcome to Modern Finance. Today, Elon Musk officially put in a bid to buy Twitter for $54.20. That's right, $54.20. At that price, Twitter would be worth about $43 billion, and that's about a 20% markup over where Twitter is trading right now. So what does that mean? Does that mean that Twitter's share price is immediately going to jump to that price? Does it mean that Twitter's share price is going to fall? Should you buy? Should you hold? What should you do with this information? Is this actually useful for you as a trader or someone who wants to make a profit or as someone who wants to invest in the long term? Is this something that could benefit you or is this something that's going to hurt you as an investor? I'm here to tell you the answer to those burning questions. But first, to comprehend those answers, what we need to understand is how much is Twitter actually worth? So, the way that I like to do valuations is different from the way everyone else likes to do them. I've learned from people who are actually equity research analysts, and they do this for a living, and they do it extremely well. I've used this method to decide whether or not to invest in companies for a long time, and it has served me extremely well thus far. And it's basically the same way that Warren Buffett decides if he invests in a company. That is, determining the intrinsic value of the company, or basically the free cash flow that will be earned and directed to the shareholders of the company over the lifetime of the company. This is understanding how much you should be willing to pay for something. You shouldn't be willing to pay a penny more than what a company is worth because stocks don't really provide much value beyond their return on investment. And obviously, you're going to discount earnings that come further and further in the future because those earnings aren't going to be worth as much to you. We're also going to talk about inflation and how interest rates impact the valuation of companies like Twitter by actually impacting how much we discount the future cash flows that those companies are going to earn. I define Twitter as basically a high to medium growth tech stock. They are technically not profitable in 2021, but they do have free cash flow by some metrics, which means they're bringing in more money than they spend. And that's exciting because it means that we can perform what's called a discounted cash flow valuation. We can look at the cash flows that Twitter is bringing in and project them into the future and arrive at a share price or valuation for what we think Twitter should actually be worth based on the intrinsic value of the company. So if you've been wondering what the hell a share price actually means, and if it has any connection to reality, this video is going to help you understand that. And it's also going to help you decide if you should invest in Twitter, or maybe if you should just put your money somewhere else. All right, let's get started. All right, so here we have my valuation for Twitter, and I'm going to explain exactly how I arrived at this share price here of $54.20 or $54.20, the same price that Elon Musk is offering for the stock. So there's a few assumptions that we need to look at here, and these are going to be critical for making your valuations. And if you don't understand where these numbers come from, you're going to get really wonky results. So let's take a look. So first we've got our sales growth, and this is going to be extremely important because it's how we define what we think the company is going to do in the future. So what I did to understand the sales growth is I looked at the past years of how Twitter has been growing, and I extrapolated that into the future, and I saw if it would be reasonable. Twitter has about 400 million users, and 200 million of those are active users. So I think they have a lot of room in terms of user growth and potentially a lot of room for growth in terms of revenue. So I think they are a high growth company with high growth potential. And they have had 50% growth years in the recent past, and they have had 36% growth years as recently as 2021 in terms of sales year over year. So I think a 20% growth number over the next 5 years is totally reasonable for Twitter, and it's actually totally doable. Looking at the tax rate, this is just an average for the company, 25%. It makes sense. The discount rate, this is going to be extremely important, and we're going to talk more about this. But essentially what you want to do is you want to understand that money now is worth more than money in the future, especially with inflation. If I were to hand you $100 today, or I could say I'll hand you $100 a year from now, you would obviously take the $100 today. $100 a year from now might be worth only $90 today. Basically, if you got $100 in a year, it's not going to buy you the same amount of stuff that $100 would buy you today, and you have to wait for it. So obviously you're going to want to take that into account. And this discount number, we don't just pull it out of our asses. There's actually a really great way to determine what your discount rate or the weighted average cost of capital for a security should be. Everything else kind of flows from that, and we predict based on the company's past and projected future cash flows. So let's get started by taking a look at the beta tab, and this is how we get our weighted average cost of capital. First, we'll see the 10-year rate. And this is interesting because why does the 10-year rate factor into our weighted average cost of capital? When you're choosing an investment, what you want to know is what else you can do with your money, what you could potentially gain by putting that money in something else. So if you put your investment in a 10-year bond, for example, what return could you get compared to if you took that same money and invested it in a company? A 10-year bond is as close as you're going to get to a risk-free investment, so we call that the risk-free rate, because if you put your money with the US government for 10 years, they're probably going to pay you back. For all intents and purposes, we consider this a risk-free investment. So we take that into account in our weighted average cost of capital here. And then we have our RM, which is the return of the market. And to determine that, I just took S&P 500 returns for the last 5 years and averaged them out. And we're getting about 14.03% average per year. We have this complicated looking equation here, and this is your capital asset pricing model. What this does is it takes a combination of the market rate and the risk-free rate. It brings those together and compares them with the beta of your security. Now what a beta is, we'll go up here. The beta is basically a correlation of how your particular security trades compared to the overall market. So we know that a beta of 0.8 means that there's an 80% correlation, a positive correlation, with the stock price of Twitter compared to the market. So that means if the market goes up $100, Twitter will probably go up $80. So that means Twitter's slightly uncorrelated with the market, which means that you're going to have a slightly lower expectation for a return from Twitter than you would with the entire market, because it seems that Twitter is actually a little bit less risky compared to investing in the market because of that 0.8 beta. Pumping all those numbers into our capital asset pricing model equation, we arrive at an RE, or equity risk premium, of 12%. So are we done? Do we plug 12% in as our weighted average cost of capital? No. What we need to do is we need to take into account Twitter's asset structure, how much debt they have, how much equity they have, and understand how that can impact the expected risk premium. The reason that debt is important here is because it actually increases the risk of a stock. The more debt you have, the riskier that stock becomes. Now, debt does have an advantage in that it lowers your tax burden, so that also needs to be taken into account. We do that with this equation here, and that allows us to incorporate the tax rate, our debt rate, how much debt a company has, how much equity a company has, and the equity risk premium that we calculated using the capital asset pricing model. And by grabbing the company's debt, which we know is $5.5 billion, you can just look that up, and the equity value, which you can just figure out by multiplying the share price by the number of shares outstanding. So that's currently $36 billion. You add those two together and you get V, which is the enterprise value of the company, or the total value of all the company's assets and liabilities, and the debt rate, which you can look up online. But Twitter's debt rate is the debt rate that they pay out for their bondholders. So if Twitter takes on debt, they'll pay you 3.875% return on your investment, or return on your loan to them in terms of debt. Twitter's bonds pay out 4%. Plug those all in, we get a weighted average cost of capital for Twitter of 12.57%. So you can see that because of that debt that Twitter is carrying, we actually have a higher risk premium compared to if it was an entirely equity-based company. In order to figure out what we're discounting, we need to first figure out what Twitter's cash flow looks like. So what I did was I looked back several years, but let's just do 2021 because that makes the most sense to project forward. And we saw that in 2021, Twitter had revenue of $5.08 billion. They had a cost of goods sold of $1.8 billion, a gross profit of $3.28 billion, which is just your revenue minus your cost of goods sold. And they had general and administrative expenses of $3.01 billion, R&D expenses of $1.025 billion, some other operating income in this case because it's positive. Adding those all up together gives us our earnings before interest and taxes, what Twitter made before paying any interest on their debt and before paying any taxes. Twitter was taxed at a rate of around 25% in 2021, but because they had a negative net income, they actually paid negative taxes, or they got a tax credit for a future year. So that's pretty good for Twitter. Even though they lost money, they get a tax break. Twitter also had depreciation expenses, and when we're calculating our cash flow, what we're trying to understand is how much money came in and out of the company, and since depreciation is a non-cash expense, we don't include it. We do include it in the calculation for tax. We actually include depreciation, and then we back out and uninclude depreciation because they don't actually lose that money. The asset is going down in value, so there's no cash coming into or leaving the company. There's a change in net working capital. That has been very minimal for Twitter, and this could be an important factor. So if you find that my results are different from yours, this could be the reason why. CapEx is the capital expenditures, so the equipment, the property, the plants, the things that Twitter buys to be able to create capital projects and to create wealth. They spent $1 billion in 2021. That essentially altogether gives them a free cash flow of negative $1 billion in 2021. Well, that sucks. So Twitter has free cash flow in 2021 of negative $1 billion. That's unfortunate. However, what matters here is really what Twitter's going to do into the future, not what they've already done in the past. Projecting their growth out into the future with a 20% growth rate in sales and a few assumptions in terms of how their cost of goods sold, gross profit, and G&A increases over time, we can arrive at a future cash flow of $1.603 billion for 2022. Expanding that out over the next few years, we could see that Twitter could have free cash flow of $3.1 billion by 2026. The way that we arrive at these numbers is really dependent on how you see Twitter's cash evolving. What I looked at is the general trend in how much they're spending and how much that's costing them to make that much revenue. So how their cost of goods sold and how their general and administrative expenses scale with how much sales they have. And these things might not scale linearly. They might scale differently depending on different factors, but I think that's a reasonable assumption in this case. Under Elon Musk, they're going to continue spending money on R&D, so R&D expenditures are not going to go down. They're going to go up over time, probably as much as their sales increases at least. And other operating expenses will go up a bit over time, but I don't see those playing a huge role. So we're seeing Twitter having a positive EBIT and having to pay taxes over the next few years. And they're going to continue having depreciating assets, so we'll have to keep adding that back in. And they're going to keep making capital expenditures, so we're going to keep subtracting that back out to get our free cash flows. Why can't we just take all these numbers and add them back together? Well, The reason for that is basically because those numbers are apples to oranges. Money today and money in 2023 are not worth the same. So that's where our discount rate comes in. We need to look at these future cash flows and we need to discount them back using this discount rate here and a formula that is up on the top here that you might be able to see that basically allows you to take the number of years away from the year that you started and multiply it by the discount rate and raise it to the power of the number of years that you're looking at, and that gives you the discounted free cash flow for that year. Essentially what you're looking at is the present value of those future cash flows. In 2021, our present value is the same because we're looking at money this year right now. In 2022, we're looking at a slightly discounted amount, and then things get more and more discounted as you go further and further into the future. We get a total net present value for the first 5 years out for Twitter of $6.8 billion. That's not that great. How do we get way up there? How do we get to this huge enterprise equity valuation that Elon Musk was citing of $43 billion? What we need to understand is how much is Twitter going to be worth from now until the company closes. So essentially we need to assume that Twitter is going to run from now until infinity and continue discounting back. So there's a cool trick that you can use for doing that. You take the year of the last amount of cash flow that you actually calculated for, and you simply divide that by your discount rate, and you subtract from the discount rate any terminal growth rate. So that's this number here, and that's basically how much you think Twitter is going to continue to grow by after the 5th year. So we think for the next 5 years, Twitter's going to grow at 20%, and then from then until eternity, Twitter's going to grow at an average of 6%. If you ran this out and you extended this spreadsheet and you kept doing this for 1,000 years, you'd end up arriving at a similar number to this. We're looking at a present value of the terminal cash flows of $46 billion. We have an equity value of $47,695 million. Why isn't the equity value these two numbers added together? Well, it is, but you also have to subtract Twitter's debt of $5.5 billion. So if you take these two numbers, subtract Twitter's debt, you get an equity valuation of $47,695 million. That is pretty damn close to Elon Musk's $43 billion valuation for the company. With $880 million per share, we get a share price of $54.20. Of course, your results may vary depending on the numbers that you plug into the spreadsheet, but I think it's reasonable to assume that if Elon is using similar numbers to this, he sees that Twitter could be worth about $54.20 per share. And the way that we got to that was we just took the equity value and we divided it by the number of shares outstanding. So 47 billion divided by 880 million shares outstanding gives us a share price of $54.20 per share. Regardless of what you think about Elon and what he's going to do to the company, if you understand what the valuation of Twitter is, you can decide whether or not you want to invest. If you think Twitter on its own is worth at least $54.20 a share, that's good for you. But the point of this video is to understand how to intrinsically value the company. What Elon is doing here is he's pretty much guaranteeing that the company will actually get bought for at least $54.20 per share. So I think there's a very strong likelihood that the price is going to run up to at least that price, because typically what happens when a company gets bought out, the share price ends up equaling exactly what the company ends up getting bought for. In the run leading up to Elon Musk purchasing the company, or it getting bought by someone else, or the company continuing to be publicly traded, I think that it's pretty likely that the share price for Twitter will go up to $54.20, because if Twitter's board, who is acting in the interest of the shareholders, decides not to take this offer, it doesn't make any sense, because they have to take an offer that's best for the shareholders. And right now, the share price is below that $54.20 mark. So unless the share price starts going up, or they get another offer for Twitter that's actually more valuable than $54.20, I don't see how this price couldn't be realized. So if you're buying Twitter's stock right now at $45 a share, you have a 20% upside. That's pretty great. So in my view, Twitter right now is a buy, and I've bought shares of Twitter because I think it will go up. I think it's a great idea for Elon to buy the company, but let me know what you guys think down in the comments below. Do you like this free speech idea of Elon's? Do you like what he's planning to do with Twitter? Are you excited about this buyout? Would you buy Twitter? Are you buying Twitter? Let me know what you think down in the comments below, and watch this video to help you find out more about how to value companies and more about how to understand the discounted cash flow statement. But for now, guys, that's all. We'll talk to you all in the next one. Peace.